Warren Buffett is a living legend, there is no doubt about that. Although he is a really good investor, he credits much of his success to the American tailwind, basically referring to the sustained prosperity that the US has enjoyed ever since the end of World War II.
That makes sense.
Since he is so popular and such an inspirational figure, it is hard not to just copy him. I get it. But here is my take on why you should not do just that. Number one, we live in a different world. When Mr. Buffett started to invest in the stock market, the investment world was very different than it is today. Information was harder to come by, and you often had to do your own digging into the company financials to really find some promising stock. There was no easy access to information such as through the internet, and so no easy way to screen for stocks with certain characteristics that we often look for, such as the PE, PE, ROE, and dividend yield numbers. Fewer people were also investing during that time too, so information did not travel fast and among many people like we have these days. Today, it is arguably much harder to find mispriced stocks that Mr. Buffett loves so much. Because technology is just so advanced, information gets reflected into the stock price even before you get to hear about it. The world has drastically advanced from the time which reflects Mr. Buffett's favorite holding period, forever. Holding stocks forever may have been a good option during time when Mr. Buffett was at peak of his career. However, the economy undergoes massive transformations every couple of decades. Everything changes, from the choices we make, the businesses that emerge, and even the macroeconomic environment that we live through due to crises, wars, and political regimes. And so, even if you buy shares of a great company today, it will make little sense to never expect to sell it. Just think of S&P 500. Companies enter and exit this index all the time. There are always new players entering the market with the potential to become future leaders. And so there is a huge opportunity cost if you hold on to a single company for a very long time without any exit strategy. Number two, diversification is not for fools. The more risk you take, of course, there is the potential to have higher reward, but also a potential to have higher loss. And one of the ways Mr. Buffett was able to generate amazing returns is by concentrating his money only in a handful of stocks. This is why he is famous for saying things like diversification is protection against ignorance, or you only diversify if you don't know what you are doing. And of course, he is correct, and the point about diversification can be proven mathematically, so we cannot argue about that. But the problem happens when we as investors take such a quote at face value. Good stock picking is an extremely tough job, which is why 80% of active fund managers aren't able to outperform the market. And so, even if the fund managers with all the information available to them cannot beat the market with a handful of stocks, what chances do we have? As retail investors, we are definitely at the most disadvantaged point in terms of information availability. Companies like Berkshire Hathaway and other asset managers would conduct month-long detailed research onto a company before that company goes public in an IPO. And if they like the company, they will back it with tons of money and at a discounted price per share. And if we, simply as spectators, watch Mr. Buffett buy a share of company X at price Y, it is very, very unlikely that we will be able to get the same price for our own portfolio. And based on the pecking order, if something does go wrong with the company, we would probably be the last to know about it, and that too through some sort of news article rather than attending any company calls or event. What this means is that if a company share price gets negatively impacted, then we are likely to take the biggest hit. This is why diversification is just so important for retail investors. It really helps to minimize those losses. A simple rule of the market is that it's harder to go up than it is to go down. For example, if a £100 stock falls by 50%, it needs to rise by 100% just to recover its value. Number three, the stock market is a device for transferring money from the impatient to the patient, and we simply don't have his level of patience. Let's face it, you and I don't want to wait until we are 60 to enjoy our wealth. And if we somehow become super wealthy in a month's time or a year's time, we would like to take it easy and chill for the rest of our lives. But this is not the case with Mr. Buffett. When he buys a stock, he invests that money into that company and waits for his capital to be returned back to him over the next many years. That's basically the way we calculate true intrinsic value of a company. We look ahead into the future and figure out how much that future is worth now. Investing like him means you should be willing to digest losses and still stick with a company if your conviction remains intact. And when the prices starts plummeting, keeping a very high conviction on so little information just becomes really hard. So you would always have to pick your battles very carefully. Is the stock worth holding on to for the next 5 years, or are you catching a falling knife?
I understand nothing.
As a stock picker, the only real way to make a decent decision about whether you want to sell a stock is by following the company news 24/7 and keeping up with its business. When Mr. Buffett was asked how to get smarter and make better decisions, his answer was to read. And he said, "I just sit in my office and read all day." So, the question is this something that you will also be willing to copy? And number 4, he also makes mistakes, so why copy that? Everyone makes mistakes. No investor is completely shielded from it. Mr. Warren Buffett also made a couple of mistakes during his investing career, and he does not really shy away from talking about them. There are a couple of mistakes that are popularly quoted, such as his buying decision on US Air stock in 1989.
What we did was we lent money to US Air. It was a terrible mistake. I made the mistake.
When he bought the stock, it showed great revenue growth. But over time, the company could not return capitals back to its investors as was expected. And so, at his 2007 letter to Berkshire shareholders, Mr. Buffett mentioned that sometimes businesses look good in terms of revenue growth, but they require large capital investments all along the way to enable this growth. Which was the case with this airline company, as they often require a large sum of money continuously in order to buy new aircrafts in order to grow. Now, closer to home, did you know that Tesco was one of Warren Buffett's investing mistakes? He invested in the company in 2006, becoming one of the largest shareholders, even though Tesco was issuing several profit warnings. In 2013, his company finally started selling the shares, although not fast enough. When in 2014, Tesco was hit by a large accounting scandal for having overstated their earnings, Berkshire Hathaway was still the third largest shareholder. And so the lesson that Mr. Warren Buffett took from this mistake was to get out of a company sooner and quicker when he loses faith in their management or business practices. And now, closer to time, Mr. Warren Buffett also revealed that he sold some of the shares of Apple stock in 2020 during the pandemic, to which he said that was probably a mistake. And finally, number 5, being inspired and learning his principles is enough. Basically, I'm trying to say that be inspired by his investment, but don't copy his decisions. The stocks that Mr. Warren Buffett buys for his company may not be suitable for you, and the stocks that he forgoes or does not buy may actually be pretty good for you. For example, Mr. Warren Buffett has shielded away from emerging tech companies in the past because he didn't quite understand their models.
And we don't want to try and win at a game we don't understand.
New and emerging tech companies are much harder to model in the traditional sense because you don't have a lot of information about their past. And because they are just so new, you don't really have a lot of good confidence in your ability to forecast their future revenue growth. And so Mr. Warren Buffett's portfolio does not include stocks like Google, which is something that he actually regrets. At the 2017 Berkshire Hathaway annual shareholders meeting, he told investors he made a mistake by not purchasing shares in the tech giant Google years ago when he could get them for only $10 per share. So just to reiterate, all I'm saying is be inspired by him, follow his principle, and that should just be enough. You don't really have to go and start copying his trades. His philosophy can be a really good guide to anyone, any investors, because his focus has always been on sustainable growth and long-term investing. Although he is against wide diversification and spoke of holding a company forever, he also advocates for keeping investing simple. So at the end of the day, there is actually quite a lot that we can all learn from this great investor without needing to exactly copy his trade. Would you say this is a fair thought? Do let me know in the comment section below. And until next time, look after yourself and your money.